All right, welcome everybody. Welcome. Let's get started. Tuesday evening, Israel Keys Wealth. The markets are live and so are we. Right, so we're gonna go for somewhere between an hour and a half tonight. We are carrying on with our study on the market maker philosophy. We are also going to do some analysis before we're done with the night, just to look at the markets, what they've done so far this week, some trading opportunities over the next couple of days. So come on in. Good to see you, Sonny. Come on in, and if you know anyone who should be here, send them a link. Let them know that we are starting off. Right, so on Sunday, I started a very interesting and perhaps the most important series of webinars so far for those of you who've been on since last year. If you're coming onto the YouTube channel, we're doing some of these free live on YouTube just so you can give people a chance to get a flavor of what we do here at Israel Keys Wealth. Yesterday I was on with Talkbear. We looked at what did we look at yesterday? Yeah, we looked at order blocks and introduction to liquidity profiles. And then we did some analysis. And then on Sunday, I started talking about the market maker philosophy. So all the technical information that I've been giving you over the last few months, we're starting to pull them all together now. And the purpose of this market makers series is to show you the why. Hey, good to see you, D. To show you the why behind some of the stuff that we teach in the markets, and to help you understand how to trade, not just following instructions or chart patterns, but to understand what it really looks like in the mind of the people that we're following. So I'm going to share my screen with you in a quick second. Let's get this rolling. And so we started looking at on Sunday, the fact that the foreign exchange market is driven not by people like you and me in our rooms. Okay, let's get rid of this now. Not by people like you and me in our bedrooms with $1,000 here or there, but it is driven by players with extremely deep pockets. Let me repeat. The foreign exchange market is driven by players with extremely deep pockets. 70 to 75% of all the transaction by volume. So we're not talking about the number of traders. We're talking about the amount of capital that each trader holds on aggregate. 75% of all the capital traded. And also, let me remind you, Forex is a $5 trillion per day market. Let me repeat that. $5 trillion. Did you get that? Let me repeat. Trillion with a T. $5 trillion is traded on the foreign exchange market per day. Right? Per day. Just think about that for a second. That is more per day than some entire developed country stock exchanges trade per year. And 75% of all that capital is controlled by 10 entities. If you want to know what the 10 entities are, mentorship program, the curriculum's there, but just take that to your bank for now. 75% of $5 trillion a day is controlled by 10 entities. and they are all what we call investment banks. I'll give you a couple of them: Goldman Sachs, HSBC, the Citibank Group, Deutsche Bank. These guys run the thing. They literally control the foreign exchange market. They've got a vice-like grip on it. And this is important to note. The way they trade is completely different from the way the vast majority of what we call retail traders trade. So you're a retail trader if you, one, have an account size, I don't know, anything less than a few million is retail. And secondly, if you're trading to speculate, you're in the market merely just to make a profit, get in, get out quickly, you're a retail trader. Foreign exchange market is divided into three major groups. Let me put this on your screen real quick. Just go over it just a real quick. We have what we call commercials. These are banks and other financial institutions who are in the wholesale market in Forex. So they don't trade just for the sake of trading. Their business involves clearing currency. So those are the commercials. Those are those 10 entities and a few more. And then you have also what we call the large funds. So I'm talking about billion-dollar hedge funds. Now, these two categories of people are who move the foreign exchange market. You with your nice $1,000, even up to $1 million account, you're not moving anything. You're literally riding the waves they create. And we looked at this on Sunday, that when an elephant walks through your back garden, it cannot help but leave footprints. The elephant doesn't need to want to leave a footprint. It just has to leave a footprint. And so what we see in the market, these large moves that you see, especially on the monthly, the weekly, the daily, and the 4-hour time frames, these are all driven. So for instance, if you see this run up in price here, from here to here, from down there all the way up to up here, that's not something you in your bedroom can move. That's something that a market maker has done. They understand how the markets work. Like I said to you on Sunday, they have access to information you don't and you can't. But then they also have access to information that you can if you know what to do. But most retail traders don't do that. And I showed you on Sunday how, for instance, a retail trader who I will call dumb money moving forwards, meaning people who put money in the markets and don't understand what they're doing, will draw a trend line here, right? And say that when this trend line broke and retested, that's what made price go down. And then they will wonder why price came all the way back up here, because as far as they're concerned, it should just go down. Now, if you were in the seminar, in the webinar last night with Topway and myself, we called this, didn't we? And not only did we call it, give me a quick second. Not only did we call it, okay. Not only did we call it, I actually took the trade. Now, this is on my demo account, so I just want to show you this real quick. This is what I call my throwaway demo. So I actually took this trade real quick today just to test it out. And there we go. Because we understand what the market makers are doing. And we call them market makers because they make the markets, right? They control the direction of price. And so if you trade with them, you do just fine. If you intentionally or unintentionally trade against them, right? Simply because somebody told you, some sleek person told you that, you can draw a trend line or throw stochastics and things like that on your charts, you're going to be in trouble. Like I said, this is my throwaway demo account. This is why I just test out different things. That's why I teach you with it, because it doesn't have any real trade information on it. And so just threw something in there just to see that zone would be respected, like we called yesterday, and it was respected. Now, I actually took the trade also on my live account, but I'm not going to show you that. I came out. I'm going to go back in tomorrow because I don't like holding overnight if tomorrow morning plays out correctly. So Where was I? This is how retail traders trade. This is not how market makers trade. They understand what drives price for real. And your job to be successful in foreign exchange is to understand how they think and to move with them. So go back and watch Sunday's webinar, Market Maker Philosophy 1, and also yesterday's webinar with myself and Talkbear. So now let's carry this on a little bit further. Now, I said this to you on the analysis webinar yesterday, but I'm going to break it down a bit more today. This is how market makers work. This is the foundation of what you need to understand about them. They buy at a discount and sell at a premium. Let me put that in capitals. If you remember nothing else, remember this. They buy at a discount and they sell at a premium. What does that mean? Let's get rid of that trend line. They buy at a discount, they sell at a premium. Discount means price is cheaper than it should be. Premium means price is more expensive than it should be. The question then becomes, who makes the decision as to whether or not price is cheap or expensive, and relative to what? Now, the answer is the market makers decide when price is cheap and when it's expensive. Doesn't matter what you think, all that matters is what they think. And so if you learn to understand three things: one, to a market maker at this point in time, is the price at a discount, at a premium, or is it fair or equitable? In essence, is the price of this thing what it should be? Or is it more expensive than it should be? Is it cheaper than it should be? So let me give you an example real quick. If we put this back in, this zone I just showed you, right? There we go. So from here to here, from this price range here, which is what 107.73, all the way to the top here, which is 1421. That's a price range. The price started out down there and rose all the way up here, and then started coming down. In essence, somebody thought that 107.72 was too cheap, but that 11417 was also too expensive. The question is now, in relation to what? What were they judging by in coming to the conclusion that this was too cheap or too expensive? I'm glad you asked. That's the first thing you need to understand about market makers. As of right now, is price too cheap? Meaning, is it a discount or is it at a premium? When it's at a discount, they will buy. If they buy down, so if they buy here, the price is going to go up. When it's at a premium, they will sell. When a market, think about it, if somebody dumps $100 billion into the market in one direction, it's like throwing a whale in a bathtub. It's going to move the price significantly. And so what you're seeing is the second thing you need to understand now, let's put it this way, is the exchange of liquidity between market makers, between the big banks or the banks and the funds. So that's the first thing you need to know. They buy discounts at the premium. Second thing you need to know about market makers is they hunt liquidity. And I'm going to explain that to you. So let's put this here. Let's put text properties. So one, they buy at a discount and sell at a premium. Number two, they hunt liquidity. And I'm going to talk to you about that today. Two is they hunt liquidity. Now, we explained this a little bit on Sunday, but I want to go a bit deeper into that today. If you want to take a trade that is going to dump $10,000 in the market, there'll always be someone. I mean, foreign exchange, like I said, is a $5.3 trillion market a day. One of the reasons it's that great is there's huge amounts of liquidity. For those of you who've started going through the Market Breakers course, we explain the different reasons why people buy Forex. People might want to trade, transfer money from one country to another. Governments are paying one to another. Huge corporations, people going on holiday, buying holiday money from one currency to another. But beyond that, there's a huge chunk of that that's just people like you and me who want to profit from foreign exchange, or who are trading for profit. We call them speculators. Just going to put that out here. We call those people speculators. Let's put that there. And you can have large speculators and small speculators. It doesn't really matter. What matters is, does a person have a legitimate reason to be in the market other than they think they can make some money on the movement of a price pair? Let me know in the comment section if you guys are still following me. Then there's speculator. Now, whether or not the speculator is a large or small one, it means they need someone to give them liquidity. Let me explain. If I want to sell you $1,000 into pounds, I need to find someone to buy $1,000 from me. It's called the market for a reason. There's trading going on. So when you come up here and you click sell or buy, and the beauty of Forex is, because we're trading contracts for difference, we've explained all this on the other videos on the channel. They're all free. Go watch them, what a CFD is. I don't need to buy before I sell. It's like I go to the shop. To buy would be, I just go to the shop. There's a Bentley for, I don't know, 500 grand. I put my 500 grand down, drive my Bentley away. However, if I find someone who wants to buy a Bentley from me, and I know there's one to buy for 500 grand, I can sell them the Bentley for 550 on credit, take the Bentley from the shop, give it to them with a contract with the shop dealer, and then bring the 500 grand back and keep my 50 profit. So in Forex, you can sell before buying. That's how it works. But whichever way I'm doing, if I want to sell the Bentley, someone needs to be ready to buy it. If I want to buy a Bentley, someone needs to have one to sell. You don't have a problem with liquidity if you're a small speculator or you're a person buying holiday money. But if you are a bank or a central bank or a government that wants to move $100 billion, you're going to have a hard time finding someone who will take $100 billion from you the other side of the transaction. So they have to hunt liquidity. Now, they have, give me a quick second, guys, one quick second. Right, so I just had to fix something real quick. So like I was saying, all right, cool. Just had to fix something real quick here. Liquidity means someone's ready to take the other side of your trade. Now, these market makers have access to pieces of information that you and I don't. For instance, they know at any point in time, they know the total volume of orders in the market in either direction. And they have pieces of information that show them. They don't know who has what order, but the total aggregate number of buy orders and sell orders at any point on the price chart. They have access to that information. They also have access to the information of the orders that other market makers have both ways going into every week in the market. And so they have a vested interest in moving price to certain price levels because they know there will be liquidity there. Let me repeat. They know. I'll give you an example. If I throw here a line there, they know that there is likely to be liquidity here. Now, you and I know why, because it's a high. But they don't just have that to think about. They have real-time information that tells them that there's $20 billion worth of orders there. And so if they want to sell, no one's going to sell to them here at the values they want. They have to drive price up there and do what we call engineering liquidity so that they can pair their orders. Hit me in the comment section if you're following me. So they hunt liquidity. The third thing you need to know about them is also related to liquidity, is they engineer liquidity. So not only are they moving to areas of price where they know there will be liquidity, and again, we've defined liquidity in the previous videos. They are all free. Go to the Forex Foundation playlist on this channel. If no liquidity exists, they have schemes they can use to create liquidity. And I'm going to show you that today. So they buy at a discount, they sell at a premium, they hunt liquidity, they engineer liquidity. And the fourth and final thing that you need to know about them today is this. They need to incrementally, spell that correctly, incrementally price in their orders. And what that means is, because they are trading such huge volumes, they can't put that 40 billion in the market at once. It will cause mayhem. Because if you know economics, supply demand, if demand increases, price increases. In essence, if somebody finds out that someone's buying all the Bentleys in town, that one particular individual is buying all the Bentleys in town on one day, every Bentley dealership is going to put up their price. If there are too many Bentleys in the dealership and they need to sell them, they have to create a sale. And so them dumping the money in the market all at one go will not be efficient for them. Price will move too quickly against them. And so they incrementally, if they want to sell up here, like I showed you guys yesterday and on Sunday, they start pricing in their orders gradually. And so even though price is going up here, every time you see a small dip, you know that somebody is pricing in an order. And then finally here is the final turning point, and it goes round. So these are the four things you need to understand about market makers. One, they buy at a discount, sell at a premium. So the question then becomes, how do you figure out what is a discount and what is a premium to them? Not to you, to them. Secondly, how do you spot liquidity on a price chart? They have tools that you don't have that lets them spot it in raw figures. But over the years, the decades we've been trading, I don't mean myself alone, the decades and decades trading has been happening. We have learned as traders principles as to how to look at a price chart and see liquidity. Remember, we looked at this yesterday. We're trading time on the horizontal axis against price on the vertical axis. And so there's two or three things you should, I'm not going to type this out because of time, but there's really two or three things you should be looking at every time you open a chart. Everything else is useless. The first is, what are the key time zones? Meaning, when is something likely to happen? What is the time of the day, time of the week, time of the month, or time of the year? Secondly is, what are the key price levels that are being respected on that chart? And the third thing is how to spot liquidity. In essence, when you look at a chart, there are things, we call them in Israel Keys Wealth, liquidity profiles. In essence, there are patterns on a chart that tell you that 9 times out of 10, a huge amount of liquidity is resting in a certain area. If you know what these liquidity profiles are and you know how to see them on a chart, and we looked at one of them yesterday with Talkback, that was the order block. That's one of about 7 or 8 liquidity profiles. Then you know that the market maker is going to be hunting liquidity. They're going to be waiting for price or moving price to get to certain levels, certain places on the chart where liquidity is, where orders are, to pair with where they want to go. The third thing is they engineer liquidity, so you need to be able to spot when a market maker is engineering liquidity. We call that a manipulation. When a market maker engineers liquidity in trading, we call that a manipulation. Put that in there in capitals. A manipulation. In essence, somebody is doing something to the market intentionally to get people, we call them dumb money, uninformed traders, to make a decision that the market maker can capitalize on. Let me repeat. Engineering liquidity means to manipulate the market, to do something with the market with their orders. So they will dump money or take money out of the market in the short term, specifically to create a scenario where an uninformed trader makes a trading decision that they can capitalize on. So if you know how to spot manipulations, then you're good to go. And finally, if you understand they need to incrementally price in their orders, meaning they need to give you advance notice of what they're doing. They can't just jump in and go boom. No, I don't know how to stress this. If you just learn to be patient in the market, you'll be straight. If you learn to be patient and let the market maker tip their hand, let them show you let them make it clear. Don't guess. Don't try and be cute. Don't try and be a prophet. This is not the place for that kind of predictive prophecy. No. Get you a Bible in church or something. Here, you're spotting, you're waiting, you're watching for something to make it clear that an elephant is running through your garden in this direction. You wait for the footprint and then you follow the footprint. So they need to incrementally price in their orders. And therefore, if you can see the orders being priced in, again, then you'll be straight. I'm going to pause for a second here. Let me know in the comment section. Do you get that so far? I'm going to show you all these 4 things on the chart today. Relax. I'm going to give you examples practically. But do you get this? Let me know that you get it. Now, let me explain number 4 a bit more. Let's take this off for a second. Let me go into a little bit more detail with number 4 before I come to the other 3. Now, the fact that they need to price in their orders gives place to a very interesting phenomenon. That simple fact there gives place to a very interesting phenomenon. And when you are a new trader, this phenomenon is confusing. But as you get more experience and more mature in your trading journey, it starts to become second nature. And once you see it, you cannot unsee it. Now, let me put this in here. Let's call this 4B. So as a direct result of 4, let's call this 4B, and we'll call the other one 4A. So 4B is they buy, they buy when price is dropping and sell when it is rising. That right there, let me see. Let me break this into 2. That right there will save your life as a trader. Write that down somewhere. Write that down somewhere. Market makers buy when price is dropping, and they sell when it is rising. This sounds extremely counterintuitive, but you need to get it. Market makers are already buying while the price is still on the way down. So for instance, if we look at this section of the chart here, from here to there, you can see price was dropping. They started buying from pretty much here, because they can't just put their orders in at once. They have to price in the orders gradually. And so if they want to sell 50 billion, they'll put in, I don't know, 1 billion each as price is going down, going down, going down, going down, going down. And when you see this happen here, what it means is they have finished pricing in their order. And then it starts to rally. At this point now, in essence, they've already bought all the way up to here. When price starts going up, they are selling. In essence, they're unwinding their position. And so price stops here because at this point, all the buying they did on the way down there, they've unwound as much as they want for now up there. It sounds counterintuitive. I'm going to show it to you and it'll make sense. So now let's go through this one by one. I'm going to deal with discount and premium at the end. Let me start with liquidity. Now, first of all, while we're here, let me show you this. So how you can find what you need to give you a head start. If you're watching today and you want to understand what I mean when I keep saying, go and look at this, go and look at that. Let me show you. So if you go to our channel here, this is our channel on YouTube. You should be able to see it. It's Israel Keys Wealth. If you come here to playlist and you come to Israel Keys Forex Foundation. So there's a playlist here called Israel Keys Forex Foundations. This is where, so that handsome gentleman would be me. We take you through a couple of things here. Number one is the very beginning, how to set up your platform and your account. We talk about brokers, the software, the whole 9 yards, and a little bit of information about how Forex works. So, Gerard, your question as to how to get your account set up, that's where you want to go. Go watch that video. But then there's 2 videos you need to watch. One is the foundations of Forex. And if you look at this here, we talk about 10 things: trading philosophies, direction, bullish or bearish, the economics of supply versus demand, the economics of premium or discount, price swings, price versus time, trading sessions, turning points, supply, demand, volatility, liquidity. I have been told by people who've been trading for over a decade that this free video here and the next one, I'll show you that in a second, the part 2 of the foundation video, they're free. They're on YouTube. You can get a hold of them, right? We go further into liquidity, volatility, and time. People charge thousands of pounds for this. In the past, I have seen people charge thousands of pounds for what those 2 videos give you for free. Go watch them. Go follow them. You cannot afford not to listen or watch them. They will save your life at the beginning. A couple of other playlists you want to look at, the Traders Podcast, The Basics of Forex by a friend of mine, Rob Booker, the mentorship sessions, but start there. Start with the Israel Keys Foundation. Right. So, having said that, let's come back here. Let's go back to our charts. So, liquidity means where there will be existing orders you can hop on. A market maker will find willing or unwilling liquidity. Willing liquidity means somebody actually wants to enter the other side of the trade. That's willing liquidity. Let me give you an example of that. So let's come back here. Let's take this away. So for instance, at this point here, let's do it this way. Let me see. Let me do it this way. Right. So the most obvious forms of liquidity, we all say on those videos, are highs and lows. In essence, there will be liquidity zones or pockets resting above old highs and beneath old lows. We'll explain why next session, but some of you already know why. Now, a certain kind of retail trader, dumb money, are what we call breakout traders. Breakout traders believe that when price breaks through a previous high or low, it's a sign that it's moving in the opposite direction. And so the breakout trader will place their order here. They're waiting for price to break that high. And sometimes it works. I'll give you an example. If they did it here, so you see this is a high here, right? Now, if you placed an order here, saying once price crossed that old high there, you buy, you would have been fine because this occasion it works. The question is, do you know when it's likely to work or not? And so that's what a breakout trader is. They wait for price to break through an old resistance going long or an old support going short. So for instance, if you look this down there, actually that wouldn't have worked. That would have tricked you. Let me find one that would have worked. Okay, so let's use this one here. This is an old low there. So there. So if you put your order to go short to sell beneath that low there, you would have been fine. However, this happens many of the times. Not most, but quite a lot of the time. There is a breakout or group of breakout traders here. They're waiting for price to break through this high there. And so they have put a buy order. Think about it. If you are going to break out at this point, meaning you think price is going to keep moving up, you see this as a sign of strength, your order is going to be a buy. Let me know if you follow me. Can you see that? Comment section. There's going to be a buy there. If the market maker knows that they are really planning to sell, they know that this is going to be a nice liquidity pocket for willing liquidity, meaning people are going to intentionally buy there to pair with their sell order, and then they take the market down. Let me repeat. So let's put this out here so you can see it. Willing liquidity. And we're not talking about people who want to change money to move from one country to another, companies who are paying each other. The other reasons for trading foreign exchange are all willing liquidity, meaning somebody needs pounds, they have dollars, that's willing. We're talking about willing and unwilling liquidity within the context now of trading as a speculator, meaning within the context of trading the markets for profit. So willing liquidity will be your breakout traders. That's one example of willing liquidity. So they want to go bullish because they think this is a breakout. The market maker swipes them, takes price the other way. So they want to sell. To be able to sell, they need somebody who's willing to buy. The breakout trader here wants to buy, right? The opposite is true here. Let's move that down here. So again, a breakout trader who sees this coming here and breaks through there will believe that price is going to go short. So if the market maker really wants to move price up, meaning they're buying, if they engineer this here, or forget about engineering for now, this will be a nice pocket of liquidity here because they know breakout traders are going to willingly put in a sell order here. They can then pair that sell order with their buy order to take it the way they really want to go. So willing liquidity, number one, breakout traders. There is another form of willing liquidity here. If someone entered this trade and was coming down here, so they sold. Actually, I'll come to that in a second. I'll come down in a second. So, yeah. So that willing liquidity. Let me give you an example of unwilling liquidity, which is this one here. Let's go back to the buy scenario or the high scenario. Now, if a trader entered a trade here to go short, right? They're feeling very happy as price is dropping down. It's amazing for them because they're like, I'm right. I sold. So they sold here. So they sold 10 lots and they're making their money. So if they sold 10 lots and prices moved 263 pips, they're going to be up 26 grand. They are happy. They're excited. But this is what they tell you as a retail trader. Put your stop loss above an old high or below an old low. So let's assume they got in here. Let me give you a practical example. They got in down here, right? They got in down there. Let me see. So let's put 10 lots. The mega traders. Everybody wants to be the ballers who borrow houses and cars and use their demo accounts to put stupid account sizes on the internet and trick everybody. That's not how the market works. But let's pretend that this is you starting out. And so you sell 10 lots down there. You're going to put your stop loss above this old high there. At this point, bear in mind, this hasn't happened yet. So this is where you are, right? And so as time moves forward, you first of all make $6,000. Then you make $12,000. Then you make $19,000. And let's assume you're trying to get down here. You're aiming for $27,000. And then all of a sudden price starts to reverse against you. So your 19,000, let's put that back there. Your 19,000 becomes 12,000 and you're 12,000. So actually, this is where we are. So price is moving against you gradually. Your 19,000 here becomes your 12,000, and then 12,000 becomes 6,000. And then you go back to your entry price. In essence, you're at zero here. If you've been taught correctly, you don't want to take more than a 1% hit. Your stop loss, or 2% maximum maybe, your stop loss is going to be up there. This is the problem. The moment price gets here, it nicks your stop loss. Now think about this. If you open the trade as a sell order, to close it either for profit or loss, you need to remember this. Now remember, you're not just pushing buttons on a computer software. This is a marketplace. If you started the process by buying, to close it, to liquidate your position, you have to sell. So if I invest my money in a Bentley, to get my money back, either for profit or loss, I need to sell the Bentley. If I sold the Bentley as a contract for difference first, meaning I sold it to someone on credit from the dealership, to close the transaction, I need to go back and pay the dealership. I need to go back and buy it in retrospect. I need to pay the dealership the amount of money it was when I first picked it up. So if you sell here, your stop loss or your take profit are both going to be buys. Think about that for a second. If you sell here and price goes against you and hits your stop loss there, your stop loss is going to be a buy order because it's closing your existing sell order. Well, the market maker really wanted to sell, but for them to sell correctly, they needed someone to buy. And so this person whose stop loss has now gotten tagged here is what we call unwilling liquidity. Let's put that there. This person is unwilling liquidity. And a prime example of unwilling liquidity is this: a stop loss. So they didn't really want to be liquidity. They were hoping to make money, but the trade going against them, it could be a stop loss, or for some of you who learned the hard way, because if I teach you, I beat it into your brains. Never trade without a stop loss. But some people do what I call the dynamic stop loss model. In essence, they don't put one. They keep guessing and hoping the market will turn till it blows out their account. So a stop loss or a closed loss. In essence, you could close the loss yourself. It doesn't have to be a stop loss. Means you put the price in there that the trade will automatically close at. A closed loss means you just make up your mind. I'm fed up of this trade. It's not going the way I want it to go. I'm out. And many of you have seen this happen before, where you're like, I knew it. It hits there and then it starts to come back down. You're like, I knew it. I knew. Well, you were right. You knew it, but, you just didn't understand what the market maker was doing first. Now, the third type I was talking about is this. So this same market maker, let's remove this here. This same market maker wants to sell, right? And so you enter the trade here again. Let's put that there again. You enter the trade here again. And again, you put your stop loss there. However, you get here. So you get to 69 pips. Let's put our 10 lots example back for the cowboys among you and cowgirls. So you get to $6,950 here, this area here. And you decide, you know what? I've had enough. I'm going to take my wins and move on. Well, if the market maker really is wanting to get here, and why do they want to get here? Because they think that's a discount. So they're moving price to certain areas because they believe at those areas price is at a discount or premium. And so you see here the market stalls here. In essence, nobody's doing anything. If you get out at this point, meaning you say, you know what, I'm done. So you sold here, your take profit to close the trade in profit will also be a buy. Does that make sense? Whatever you start a trade with, you do the opposite to close it for profit or loss. If you sell, your stop loss and your take profit will both be buys. If you buy, your stop loss and your take profit will both be sells. So to get out of the sell trade here, you are going to quote and unquote buy. Well, the market maker isn't satisfied with price, that they want to drive it down there. And so to drive it down there, your buying to close your sell trade will provide them some short-term liquidity that then allows them finish the move up to there. So the other kind of willing liquidity is short, or let's put it this way, let's call it mid-move closed trades. In essence, when you close a trade before the move is over, you are actually supplying liquidity to the market maker to finish the move. And that's okay. There's no point being greedy. You don't need to get out at the exact low and get in at the exact high or vice versa. You just really want a nice piece of chunk in the middle and you're straight. You're good. And so this is an example using one liquidity profile of how a market maker will drive or will hunt liquidity. In essence, they are looking. Now, highs and lows are one form of liquidity. Let me put this there. Actually, I wanted to duplicate that. So there's going to be, and then we put this there. So if I put insert, so there's going to be liquidity there. And again, liquidity down here. That's just how it works. Now, there are other areas you can find liquidity. For instance, like we showed you yesterday, the order blocks up are areas of liquidity as well. I'm going to show you liquidity profiles next time. Show you the different forms of liquidity profiles next session. And so you will find, if you go through your chart, and once you see this, you cannot unsee it. Let me show this to you. If you go through your chart, go back in time, right? Go back in time and just begin to see what's going on here. You will notice that price is being driven to certain areas of the market. It's like there's a magnet there, right? They come into certain areas to go long or go short. And half of them are old highs and old lows. You just draw them out and you will see that the market is respecting these areas to go long or short from. Also, to follow up from yesterday's seminar, we talked about myself. If you just draw the order blocks, you will see the price is respecting them. It's going into them, right, to get what we call liquidity. Look at that there. Comes in here, then it starts to go down. Comes in here, comes back in there, starts to go down. The same thing works on the downside, right? 1 second, put this here. Comes in there, okay, it breaks it there, that's fine. But you can see it respects it for a little bit, And then where does it come into? There's an order block just there. If you know what you're looking for, you can see it with an experienced eye. Comes up there, comes down. And that's the way the game works. Price is hunting for liquidity, whether it's above and below old highs or lows or other forms of liquidity profiles. For instance, this is a liquidity profile here. It's a consolidation. Price comes in there and then off it goes. You need to learn to start to spot these zones with your naked eye. A time will come where you don't even need to draw these boxes like I'm drawing them. You just see them. They just jump out at you. It's like speaking a language. For instance, there's one, look at it there, right? Price goes up, comes back there, goes from there. Where does it head to this one? It comes back down. Where does it head to? You know, it's just a game of tag. Now, let's go back to the liquidity conversation we were just having. So I've shown you how they hunt liquidity. And why are they hunting liquidity? Simple, for discount or premium. And I'll end with that. How to know whether or not they will see a price as a discount or premium. Now, they engineer liquidity. They manipulate it. Let me give you an example. Now, let me find one that's clear. Oh, I've messed this up. Okay, with all my, let me go back in time. Aha. Perfect example here. And these things repeat over and over and over. And no, they're not hindsight. Those of you in the WhatsApp groups, you've seen myself and Talkback call these things for an entire year, like clockwork, right? So you know this works. So let's draw this out here. From that section in the chart, all the way down to this section, to here. So that entire area there is a downward move, as I'm sure you would agree. Right. Now, in essence, at that level there, they thought price was at a premium, meaning price was high. You want to, if you're a seller, you want to sell at the highest possible price. So they thought that was a premium, so they started to sell, right? And then down there, they thought it was at a discount, so they started to buy. In essence, their objective on this leg was to move price from there to there. Say yes if you agree or if you can see that if what I've been teaching you for 72 hours is correct and market makers really do stuff of this nature, or they're the ones who control the market, for price to move that far, let's see, how many weeks did that happen in? That was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So in 14 weeks, price moved, let's see, it moved how many pips? It moved 530 pips. Yeah, it's decent. So that's a market maker. That's not you or me without $1,000 accounts. However, it didn't just go down in a straight line. We looked at that in the Forex Foundations, retracements and expansions. Price doesn't just drop or rise. It moves in waves. It breathes. There's an expansion, then a retracement. An expansion down, then a retracement up. An expansion, a retracement. An expansion, a retracement. An expansion, a retracement. Because they're pricing their orders in as they go. Now, I want you to see something very quickly here. They got down here, and as you can see from here, there seemed to be no further momentum to move price lower. They're really trying to get down here, but they're stuck here. Look at this. They're stuck here. Nobody seems to want to buy anymore so that they can sell. So they need to generate liquidity. At this point here, nobody's doing business anymore. So this is what happens. Again, it's the same. See, generating liquidity is the exact same principle as hunting it. So engineering liquidity, sorry, is the exact same principle as hunting it. But in this case, they don't just look for it, they create it. They do something in the marketplace that causes people to put money in the market in the direction they want. Now, look at this here. At this point in time, all you can see is the market's going down. But they know at this point, one, they've priced in, they've unwound some of their order, but then also nobody seems to want to go further anymore. So this is what they're going to do. Like I said, they can simply just unwind their order. So they've been selling, right? They can close some of their positions, or they can liquidate by buying some back, and the price begins to go back up. Two things are going to happen. Look at this intermediate high here. Now, this is a 4-hour chart, so we're not talking 15-minute Trump change. There's going to be some real meat in the market on a 4-hour chart, and even worse on a daily and a weekly and a monthly. First of all, remember we talked about willing and unwilling liquidity? Let's come back here. So what was willing liquidity? A breakout trade. Okay, so let's go back there. When price gets here, what do you think the breakout trader is going to think? They've seen price drop for 1, 2, 3, 4, 5, 6 straight weeks. All of a sudden reverses. So let's take this away. There is going to be liquidity here. Now, bear in mind, as at this point, you don't know. However, as an experienced trader, as a market breaker, as an Israel Keys mentee or student or associate or whatever, you just know something's likely to happen there. Why do you know? I'm trying not to get too far ahead of myself. This is for future lessons in the Market Maker series, but let me just give you a sneak preview. You see this level here. Look at this level there. Look at that line there, right? See what happens. It's respected there. Can you see? Let me show you. Remember, these are my magic lines for the students. See what happens there? It's respected there. And it's also respected there. And here. And there. And there. And there. I could go on and on. You get the point. Also here. This is like candy from a baby, right? So you see this price level, right? This is a price level at which there has been significant liquidity in the past. There is likely to be, in essence, they thought that price at some point in the past was either a premium or a discount. And if you see it work both ways, it's even better. In essence, if the same price level has been used to engineer liquidity both ways, you can bank on the fact that when it comes back there, something's going to happen. And so there's an intermediate high here. There's a significant price level at that point. And also, one second, let's zoom this out a little bit. Let's zoom this out a little bit more. Right, so this is where we got to eventually. I can almost bet as well, let's just put a line there, that at some point in the past, that area there was significant. Let me zoom up to a daily chart. So it's that line there, right? So it's the lower purple line there. There you go. So you can see that in the past, there is a level of great activity on the daily chart there. And so that would tell me in advance that they're likely to drive price to at least that level. Once they break past this one, this seems on the daily chart to be the next great significant level. So I'm expecting them to go there, right? So this is what they have to do along the way. To engineer the liquidity, there we go. So there's a high that formed along the way there, right? They just have to, basically that high there is insurance. Because first of all, it was created by them unwinding a position, first of all, by pricing in their next order. So remember, they buy as price is dropping and they start to sell gradually as price is rising. All they need to do is drive price back above that level there. And all the breakout traders will jump in and say, it's going long. They buy. The market maker takes the other side of the deal to sell to drive it further down. Secondly, anybody who got in here is going to have their stop loss there. That's the unwilling liquidity. And so they're going to just get stopped out. In essence, if they had a sell trade, their stop loss is going to be a buy trade. It's going to provide the buy side liquidity for the market maker to sell and then drive the price to where they really want to go. And you see this all the time. This is my personal bread and butter setup, right? I delineate 2 points in the market. I'm going to show you that in a second to close today. I delineate a point where I believe price is going to go from to. So these 2 lines would be those 2 points. And somewhere in between, I wait for an intermediate high. If I'm selling, an intermediate high, or if I'm buying, let me give an example of this one. So if you're buying, it would be an intermediate low. So let me give you an example of this. You see this here. That's not very obvious, but that is slightly lower than that. Let me make an obvious one. Let me show you an obvious one. That's an obvious one there. When this happens, so we're buying, but an intermediate low forms. The price then comes back to clean out and then moves rapidly away from it. That is a sign to me that a market maker engineered liquidity here. The same way they engineered it there, they engineered it here. And I know that if they were the ones that engineered it here, they are likely to respect that level. In essence, they created it to carry on their move, and therefore I can safely put a trade in with my stop loss there because they're not going to want to violate that. That was just there for them to keep moving forwards. And if you notice, at most significant turning points in price, you will see this happen. For instance, here, there's a high form there. They clean out the high, come back down past it. I showed you yesterday. They come back into that area and there's a sharp rejection. I know a market maker did business there. If I know a market maker did business there, they're likely to defend that level. In essence, they're not going to come back there for a very long time. That's usually the start of a trend moving south. And what do you know? There we go. And then when they turn on the other end, what do? Same thing. Take out a high there. There's another high here. Low, sorry, there. Another low here. So again, there's liquidity resting there and there. They take it out, reject to the upside, come back and visit that level once and run away quickly. I know a market maker did business there. And like Tucker taught you guys a week ago, the telltale sign is the market structure break. After the engineered liquidity, you look for market structure break. There's the market structure break. Price goes beneath that level, comes back and dies. On the other side, there's the market structure break there. There we go. Price breaks market structure at that point. Comes back in that region to test it and dies or jumps on if it's a buy trade, it jumps out. You know, market maker did business there. It's likely to go up for a while. So this lasted 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. This lasted 1, 2, 3, 4, 5, 6 weeks. That's how you know, like Tucker was talking yesterday, that you have institutional sponsorship. Now, if you remember, I said they're likely to defend this level because this is where they started off, right? If you draw, let's just draw a line up here. Let's draw a line there. So this is where a market maker engineered liquidity there. They also engineered, there's one there already. They also engineered it there. Let's look at what happens when price goes back to these lines the first few times it goes back. So this is the first one here, right? When price gets to it, you see, it respects it, it leaves it alone. Because somebody with deep pockets created that level, it's not going to violate it for a while. It tries here and it sends it back down. Eventually, somebody with deep pockets says, let's try that level. It gets to above it, meaning that same level where liquidity was generated before. And the second time it goes there, it runs away again. You can see that because there is $50 billion or something similar in that level above that line, just above that line. It's going to take someone with the same level of liquidity in the opposite direction to violate it because it was engineered. And what do you know? It gets violated here. It comes to just above that first level to clean up more liquidity, and it, see what happens? It runs down again. This ping pong match is how mature traders spot market makers moving. And your job is to say, okay, a market maker did business there, meaning they're going to go down. So all the way from here to here, you have almost 900 pips to play with. If you know the direction the market makers take in the market, can you find a 30, 40, 50 pip trade in a 900 pip range? The answer should be, if you're going to be any good at trading, yes. And that's where all the other stuff we begin to teach comes in. But you first need to see what the market maker is doing. All right. Now, final thing I want to show today before I close is I'll deal with what they buy when price is dropping and so it's rising next time. So discount and premium. Let's look at that real quick. So let me open up an empty chart for that. There we go. Let me use discount and premium. You see lines. A market maker sees price ranges. In essence, at every point on this scale here, they see the price of an asset. And they're asking themselves, for instance, in today's market, a £200 house in London is dirt cheap. £200,000 in London today will buy you a maisonette, 1-bed flat. In 1985, that could buy you a mansion. So there is no such thing as cheap or expensive price in a vacuum. The question is, as of today, based on what the market is saying, is this asset cheap or expensive? Well, the answer to that, and I'm going to leave you guys on a cliffhanger today to go do some research in the charts. But let me walk up the cliff. The answer to that is very simple. If you're asking yourself, is $200,000 expensive or cheap for a house today? The question you want to ask yourself is, what was the price of the house yesterday, right? If yesterday's price was 150, 200 today is expensive. If yesterday's price was 250, 200 today is cheap. Now, it could keep dropping, but you're not to know that. You're measuring premium or discount based on historical price. And this is where the magic really begins to happen. For instance, those of you who wonder why we love Fibonacci's, this is why. Fibonacci's tell us, based on historical price, is price cheap or expensive? Let me give you an example. So, let me see. Let me use a daily chart for this. Actually, now use an hourly. I'll use an hourly. There's more activity in recent times in an hourly chart. When I drop Fibonacci from here to here, right? That's a range. In essence, that's the highest price in the range. So that's why it's marked as 100. This is the lowest price in the range. It's marked as 0. Along the way, we have 50, which is a halfway point. 38.6, 38.2, sorry. 61.8, 78.6. You can draw as many as you want. You could have an 80 there, a 65 there. You can have a 23 there. You can have a 10. You can, on the Fibonacci, you can put in your own levels. See, there you go. You put whatever levels you want. These are the levels I trade with. From experience, these are the significant levels. They're Fibonacci levels because, anyway, Fibonacci is out of the, it's not part of the curriculum for today. Go and listen to the foundation videos. So, when I draw Fib, so whenever I open a chart on whatever time frame I'm trading, I want to find out, based on where price is right now, what is the controlling high and controlling low of the range price is in. 75% of the time, the price of a pair will be in a range. It may not be off. I'll give you an example. If we zoom into a 15-minute chart, right? It's not obvious what range we're in on a 15-minute chart. If I took out the Fibonacci, you wouldn't know. In fact, let's take the Fibonacci out on a 1-hour chart, which is why we teach you the trade in pairs or in triads of time frames. Whatever time frame you're on, you want to be watching at least one time frame above and one time frame below. And by one, I don't mean the next one. Literally, the one above should be two time frames above, and the one below should be 2 time frames beneath. This is why. If I take out the Fibonacci there, and I drop down to 15-minute chart. On a 15-minute chart, the price has broken the range. You would say, well, the range was from here, right, to here. So you would say, this is the range, 0 to 100. Actually, I drew that the wrong way. Let's delete that. Let's draw it the other way around. You would say the range was from here to here, 0 to 100. 0 being the lowest, 100 being the highest. And therefore, price has broken the range. So on the 15-minute chart right now, price looks expensive because it's higher than it's been in recent time. Which is why, if you look at this, it actually comes back into that range. It's saying, hey, I'm too expensive here. So in the short term, in 15-minute increments, this is a premium. This is much higher than recent. There has to be a price correction. However, on a larger picture, no, sir. This is the actual range on the larger picture, on the 1-hour picture. And if you go further up, you see there's an even bigger range. So on a 4-hour chart, this is the range. However, we know there's price above, we just can't see it. So we go to a daily chart, and then you see that the range then increases again. So there's range above there. And on a weekly chart, it increases yet again. You see that there? And on a monthly chart, which is the highest chart on MetaTrader, it's even worse. So you are now asking the question, congrats if you made it this far. Is price at a premium or a discount? The question is, over what time frame? In the long run, right now, price is cheap. Actually, let's take this here. So on a monthly chart, that will be the lowest price point there. So, but see, monthly chart from here to there is 20. So over a 20-year period, price is cheap, right? So over the next 20 years, we will kind of expect this price to go up over the next 20 years because it's cheaper. It's cheaper than majority of the time in the last 20 years. But if you are a position trader holding a trade for months and years, great. However, if you are a scalper trading over the next 5 minutes, you don't care so much as to how expensive it is over 20 years. You care how expensive is it right now. So on the 5-minute chart, there's the range. On a 5-minute chart, it's in essence, it's above. So anything below 50% is cheap. Anything above 50% is expensive. So anything below 50 is a discount. Anything above 50 is a premium. 50 is generally seen, that region here, as a fair price. And I put in 61.8 and 38.2. They're almost equidistant from 50. In fact, they're exactly equidistant from 50 for the simple reason. Anything in this ballpark here, so roughly 12% above and 12% below, that whole region there is seen as fair price. Anything above there's a premium. Anything beneath there's a discount. Keep that in mind. Everything above here is a premium. Anything beneath here is a discount. And therefore, in this range, once price forms that low and forms that high, in this range, I am only buying beneath 61.8. And I am only selling above 38.2 if I'm taking my trade in a short term, meaning I'm scalping, so I'm looking at a 5-minute chart. Now that again, let's go back to the monthly. So let's get rid of that. Actually, let's leave that there. So on the flip side here, on a monthly, this is the fair price level. In essence, once price forms that high and that low there, you see from here all the way down, all they did was sell. Why? Because over this time frame, in the long run, over 20 years, can you guys let me know you're still following me in the comment section? You've been quiet for a while. I want to be sure I haven't lost you. In this area here, why would they want to buy? Price is expensive here. But you see, the moment they drop below 50 into this range here, now they start thinking, okay, so you see there's a little rally here. See, over here, just tiny little spikes. But the first major rally is here because now they drop down here. And then they get here. This is really, really cheap. This is close to zero. And then there's a huge reaction. Because by their calculation, price has now moved from a premium into a discount. And you can see the same principle on whatever time frame you're looking at. Please let me know if you can see this, guys. Talk to me in the comment section. I can see you guys, but you're quiet. Let me know you can hear me or you're following me. This stuff here is worth thousands of pounds. I should not be teaching this to you for free. It is worth bazookas on whatever time frame your reference or your execution or your trading time frame is. Whatever we could talk about that, your reference time frame, your control time frame, and your execution time frame. Your reference time frame is the highest time frame you look at. Your control time frame is the one in the middle, and your execution time frame is the one is the smallest one. For me, my control time frames are either the 1 hour or the 4 hour. So if it's the 1 hour, I'm going daily 1 hour 15 minutes, or I'm going weekly 4 hour 30. You can say 30 minutes, but I usually just use 15 or 1 hour. 30 minutes a funny time frame. And so on this particular analysis I'm doing here, the 1 hour is my control time frame, meaning I'm taking my bias from the daily. In essence, my key levels, my liquidity profiles, all those things, I'm taking them from the daily. But my control time frame is the 1 hour. So that's the case. Let's get rid of this now on the monthly. This here will change your life, especially for the experienced traders. This could be the difference between losing and winning. That's the controlling high and the controlling low. This is the range I'm currently in. Big picture on a 1 hour time frame. In the 1 hour time frame, each divider is a day. So this is over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So over 10 days, that's the picture there, right? Cool. So remember I said, so 0 being the lowest time, the worst price, 100 being the highest price. That's how I draw my Fibonacci for figuring out discount or premium. There's other things you can use a Fibonacci for. So 12% either side. Why 12%? Now, you won't find this in anybody's book. This is not in anybody's book. This is something I figured out all by myself. What's half of 50? Sorry. What's half of 50? 25. Right? So half of 50, in essence, half of the distance between 0 and the fair price, or the other way, is 25. If I put a 25% zone on either side of 50 or to straddle 50, I'm going to get 12.5 either way, right? So I just rounded 12.5 down to 11.8 because in the natural Fibonacci sequence, 61.8 and 38.2 are natural Fibonacci numbers. Go Google them. Fibonacci numbers are a sequence that occur in the universe. Strangely, patterns that just seem to work. Those ratios occur over and over again. And so, in essence, roughly 12.5% on either side of that will give you this. In essence, in that area, that is the fair market value. That's the fair price. Notice the vast majority of time, except for while it's down here a little bit, but notice how price seems to want to stay in that range. That's natural equilibrium. It's telling you this is roughly how I see it being. This is the fair price of this Bentley is $50,000. When it comes down here, if there's a Black Friday sale, it comes all the way down to, say, I don't know, that's 38, maybe that's 10 to $10,000 here. At this point here, it's, I don't know, $70,000. In essence, anything above here, I'm hunting a short. Anything below here, I'm hunting a long until price resets the range. In essence, Brexit happens, house prices move, a new range, because ranges are being set all the time. See, this was the range here. So, but as of right now, while price is still here until it breaks this range and forms a new range, anything above here is a premium, in which case we should be what? Selling. So when price came here, what did they do? They sold. When it comes here, what have they done? They have sold. When it came down here, what did they do? They bought, they bought, they bought. So they're selling all the way down here. And they're buying in this region here. Does that make sense? So when price is down here, once price comes out this box here, I'm looking for an excuse to go long. I don't just jump on along. I need previous information to tell me. So what do? Well, first of all, there's another block down there. See that there? It's a nice other block there. So price comes in there and reacts. Boom, off it goes. Because why? It's in a discount. Why do I also believe that's going to be a good area to defend? Well, remember I said if my control time frame is my 1 hour time frame, then my daily then becomes my reference time frame. Does anything interesting happen there on the daily? Yep. Let's throw a few lines there. Remember old highs and lows. Look at that level there. That's one. Let's just price in all the highs and lows in that region. That's another one. That's a third. That's another one there. But price hasn't gone there yet. But look at this one here. Can you see this one here? Look at this here. We're going to talk about this in a few days, in a few sessions from now. Why market makers respect previous price levels so significantly. See that level there? That's an old low. We could have drawn it out in December 2019. Just put that low there, right? Well, what do you know? In June 2020, let me see if I can. In June 2020, that same low, look, is tagged here on the way down. It's also receipt. That's the high of that. So you see that line there that we drew from June 2019? Price respects it here again, respects it here again. If we've established a range with the fair price in the middle and we're hunting a short, we're looking for an excuse. There has already been a bullish engulfing here. So price is reversed sharply there. There's an order block there on the 4-hour chart. It comes back to that level. You see how we start to building the hypothesis that we are going to see a reversal. And so you go to a 4-hour chart. You can see it nicely. See that? There. Price comes in there. It's in a discount. Boom, we buy. And if all you do is on a larger time frame, so this is, for instance, this is the daily time frame here. So let's go back to the 1 hour time frame. So if all you do is buy from discount back to fair value, it's 112 pips. If you do that over and over and over again, find price in a discount, buy it back to fair price. Find price in a premium, buy it down to fair price in a range over and over again. And to do this, just drop down to a lower time frame. So daily was our reference, hour was our control, 15 is going to be our execution. So on a 15-minute time frame, can I find an excuse to take a trade? Oh, you bet I can. Price has come down into that order block there. It's taken off there. If you miss this move, relax. The next day comes down. Remember, we talked about engineering liquidity. See what happens here. It engineers liquidity there. It taps into that liquidity pool there, into that profile there, right? And meaning it's the right time of the day. Let's see. That is, okay, well, it's not necessarily the right time of the day. Well, it is, because actually this is the Aussie dollar. And so the Aussie dollar is an Asian pair, meaning trades in Asia are valid because it's an Asian pair. So I just put my entry here. A second. Let's put this Control M. Let's find the tradable pair. All right, so if I put my entry there, and my stop loss here on my execution time frame. Remember, I'm buying it back to 50 or somewhere in that zone. So 12 pips stop loss, R out 1%, 2%, 3%, 4%, 5%. I'm at 50 and I'm out. That's it. I don't care about the rest of that. Now it gets here. Let's look at the flip side now. It gets back there. So now we're looking for an excuse to sell, right? Because now it's above that. It's in a premium. Well, there we go. Again, look at this. It's Engineer Liquidity. It's taking out that high there. So it's either hunted or Engineer Liquidity into what? Into that order block there. That one there. And again, what am I looking for? I'm looking to take the ride back down to the fair price in the middle. Roughly 19 pips of a stop loss. 1%, it's almost a 2. But 2% takes it back to 50. You can see it gets to 50 and it starts to stall. Now, these are the big picture concepts of how a market maker looks at price. As we go over the next few days and weeks, we will be refining this with a lot of the other stuff you've been learning over the last few months. And if you're new, go through all the material, both the free stuff on YouTube, but also the paid stuff in the mentorship. So I'm going to end it there for today. Now, if you bumped into this live on repeat, if you want to find out about our mentorship program, our paid mentorship program is £79 a month. We teach you all this and a whole lot more. We hold your hand, give you signals, help you develop your way as a trader. Hit us up in the description section. You will see the information, Israel Keys Group at gmail.com. Send us an email. Let's talk about how we can help you fulfill your dreams of trading in the market. So guys, I'm going to end it here for tonight. Go back and watch this over and over again. Get some questions, right? And when we run our question and answer session this weekend, bring your questions with you. Also, if you are part of the mentorship group, you can ask the questions in the WhatsApp groups. We will answer them between myself and the other instructors. It's been fun hanging with you tonight. I am about to go get some sleep. I've been up since about 6 a.m. in the morning. I hope this has been beneficial. Like the video, please subscribe if you haven't already subscribed. Send us an email if you want to find out how to be a part of the trading community. This is Israel from everybody here at Israel Keys. Take care. Bye-bye.